Hi guys, KP from InvestorWise back with another video. Hope all of you are doing good and staying safe in this lockdown. So, a lot of messages coming in. Should we buy banking stocks? Should we invest more money in banking shares? This looks a great opportunity. Should I buy these shares of banking companies in thousands and whatnot? I thought, okay, we'll make a video and I'll give you 5 reasons why you should not have overexposure in banking sector. Guys, if I give you an understanding about 4 shares right now, if I look at HDFC Bank, which is one of the best stocks in the banking sector, it has done a 52-week high of above 1300. Right now it is available for 838 rupees. Next is ICICI Bank, guys. ICICI Bank has done a 52-week high of 550. Today is available at 292. That's very cheap. If we talk about Shriram Transport Finance, it has done a 52-week high of 1350 plus, is available around 550 if I'm not wrong. A little bit here and there, please excuse me for that. And if I talk about Bajaj Finance, one of my favorite counters, it has done a 52-week high of close to 5000, is available at 1900 odd bucks. Does this entice you to over-invest in banking stocks? We have to be careful, and that is why I'm making this video here. Guys, point number 1. I feel banking shares are a mode of experimentation for both the government and the RBI. How do I prove that? If you see, the recent stimulus which has been given by the government for the sake of pandemic that we have been witnessing right now, if you see, most of this stimulus is coming to us not directly but through banking sector, through banking channels, and that is where you get to enjoy, but banking companies, they get to suffer. So basically a bullet is shot by the government, keeping the gun on the shoulder of the banks. What do I mean by this? If you see, guys, first thing what they did was they gave a 3 months moratorium period, and then they gave another 3 months moratorium period. In the process, what is happening is banks are not going to realize their income because of these moratorium periods being introduced. Yes, this is temporary, but the idea here is just to give you one example to make you understand how banks play the role of experimentation mode for the government or RBI. In fact, if you heard the other video of mine, I told you Nirmala Sitharaman has made a statement, which was a big statement and probably not a great statement to make, was that the IBC, Insolvency and Bankruptcy Code, will not apply for any defaults or for any non-payments done by corporate entities in this pandemic situation if the companies are able to prove that they are not able to pay because of the corona impact on their business, which again puts the corporates in a very strong point to not pay and still go scot-free, and putting the banks under a lot of pressure. Because you need to understand, at the end of the day, a banking business is standing just on two parameters. One is how they create credit, and the second is how they make loans available for public. Public includes people like you and me, and it includes the corporates also. If they never get back the money from corporates or the public like you and me, how will they repay their loan? And that is what is going to put a lot of stress on their balance sheets. We need to understand that. These are just 2 examples I've given you. Apart from that, if you see, monetary policies can be tweaked as and when RBI wants to do that. They can increase the repo rates. Repo rates are the rates at which banks can take funding from RBI. If they want to increase the liquidity in the market, they will reduce repo rates. If they want to reduce the liquidity in the market, they can increase repo rates. And there are so many other policies which can be framed and directly applied on the banks, making it very difficult for banks to survive in this competitive market. Point number 2, guys, banks have way too many compliances when compared to other corporates. They have requirements of CRR, SLR, Tier 1, Tier 2 capital, Basel II norms. There are so many things. Obviously, I'm not going into the details of all this, but because they have to maintain so many compliances, because they have to always see into the regulatory things, and they have to follow them, adhere to them 100%, it becomes very difficult for banks to function properly. In fact, they are under a lot of pressure from the regulatory and compliance front that they're never able to do business freely, unlike the other corporate entities, which makes it very difficult for banking stocks to perform going beyond imagination or doing much better than the industry. Guys, point number 3 is audits in case of banks are not foolproof. There are so many instances where we have seen banks or housing finance companies to fail miserably, but never did the audits or auditors, I should say, never have the auditors brought this picture clearly in front of us. Only once the problem has happened, bank has suffered a lot of defaults, only after that we get to know as general public. So as a stakeholder, as an investor, it becomes very, very difficult for us to completely trust the audited balance sheets and PL of these banking companies. Audits are not done properly. When I say that audits are not done properly, what do I mean by that? See, banking income is primarily the interest income which they derive. Now, obviously, interest income is based on how much of credit they have created. More the credit they have created, based on that, their interest income will come. But at the same time, we need to understand this credit which they have created, is this money ever going to come back to them? And if this money does not come back to them, then the whole purpose of losing your principal and only getting the interest income is of no use. So this is somewhere a job of the auditor to check the asset quality or based on what credit has been given by a bank. But in most of the cases, auditors are not capable of analyzing the asset quality in case of banks. Yes, if the bank does declaration on its own, it's fair enough. But from auditors' point of view, hardly we have seen instances where auditors have brought this as a picture in front of the investors or stakeholders that yes, bank's credit quality is not great, or we anticipate that some defaults might happen in future. Rarely we have seen that. So need to understand, guys, when you are investing in equity markets, whether you do it directly or you do it through investment advisors like me, at the end of the day, we are dependent on certain data that is presented in front of us. We need to go by that data. If the data in its place is manipulated, that is not my job to check. That is the job of SEBI. That is the job of regulators like RBI or the government. That is the job of statutory auditors. That is the job of internal auditors to see if things are being done properly. It's not for people like you and me to check the authenticity of the data that has been presented in front of us. That is why we call it audited PL and balance sheet. Companies which have got listed have to meet so many listing criterias, and even after getting listed and fulfilling all these thousands of regulations, if company inside is doing some misappropriations or manipulations, that is something way beyond the knowledge of an analyst like me. So yes, in the past, I have recommended Yes Bank shares to a lot of my clients, and the share from 150, 200 levels has come down to 25 levels. Yes, for a matured client, he will never get back to me saying, you are a bad analyst. But if you are an immature analyst, definitely you will come and tell me, your picks are not great, KP. How can you recommend Yes Bank, which is now trading at 25 rupees? That is 1/10 of the value at which you made me buy this share. Guys, you need to understand, when I recommended Yes Bank was looking very good, at least in the books. And those books are not normal books. Those books are audited books. If Yes Bank is not reporting its NPA properly, if they're not doing provisioning for its NPA properly, then in that case, for an analyst like me, I am a garib bacha. I don't have much to do in that case. I have to trust the audit reports at some point of time, and we have to make our investment choices based on that. Guys, point number 4 is, again, coming back to the same point, the NPA ratio especially for the public sector banks in India is very high. It's almost close to 14%. And as far as the private sector banks is concerned, it is still in double digits, like 10 or 11% the NPA is. So because these NPAs are not reported properly in first stage, so basically what banks will do is, you need to understand, they play some kind of a corporate politics here. So what banks will do is, they will intentionally not report their provisions properly, because as per Banking Regulation Act, they are supposed to make provisions on their assets. Assets means the loan which they have given. And if this provisioning is made properly, that will impact their profits. If that will impact their profits, then obviously people will not be buying shares of that company, and accordingly prices of those shares will come down. If prices will come down, the promoters or the management who is having a hold in these shares, they will lose their wealth. There is a wealth destruction for that. I hope you understood that corporate politics which I spoke about. So basically what they do is, they intentionally make it a point that they will not, for at least a couple of years or 3 years, till the time a loan has completely become default, they will not report it. They will not make provisioning properly in that case. A couple of years back, good thing is RBI has taken a strong stand against it, and what RBI will do is they will prepare the divergence report. So basically what RBI will do is first they will check the report prepared by the MNCs, and after that, if they feel that NPAs have not been reported or provisionings have not been done properly by the banks, then in that case RBI will come up with its divergence report, where they will talk about it, that company has reported or bank has reported so much of NPA, but as per our calculation, as per our understanding, this NPA should be much more than this. This has been done for Axis Bank, this has been done for ICICI Bank, and this has been done for Yes Bank. So you can see the top-notch banks are even not reporting their NPA properly, and I gave you my reasons for that. Why they won't do that is for simple reason: it should not reflect bad on their balance sheets or in their profit and loss computations. Point number 5, guys, is the kind of tendency which we have in India. Most of the corporate loans get sanctioned based on some influence. If you say a loan gets sanctioned only when a client is deserving enough, that probably might apply to people like you and me, that is the retail customers. But when it comes to corporate clients, most of the loans will get sanctioned based on the influential powers. You either have direct source in the bank, or you will go through some politician and you will get a loan sanctioned. So when you get a loan sanctioned, you are probably getting an amount which is 10, 20, 30 times the credit worthiness which you have, and probably you never deserved that loan in the first place. The result of which is obvious: there will be NPAs, there will be defaults of loan. When Kingfisher Airlines was given a loan, they did a total default of close to 9,000 crores, of which they owed only 4,000 crores to SBI. Obviously, do you think SBI did not have enough credit analysts who knew that Kingfisher Airlines was not having great credit worthiness to get 9,000 crores of sanction or 4,000 crores of sanction? They knew it, but still the loan got sanctioned because of some influential rights, some influential powers which have been applied by them. And later on, what happens? They will default and they will go scot-free with that. Same was the case with Nirav Modi in case of PNB, Punjab National Bank. So if you see in that case as well, he has done a default of close to 12,000 crores. Like that, there are so many instances where loan defaults have happened. So the thing is, in India, the tendency of corporates is seen to be going on a higher side in respect of defaults. Even if they don't do default, they feel CDR is their birthright. CDR means corporate debt restructuring. Anytime they can apply for CDR, where they will tell that for next 2 years we won't be able to pay any interest, principal repayments will not be done, we want a moratorium period, and they will ask for all these kind of relaxations, which obviously will have an impact on the share prices at some point of time. If I remember correctly, the same Punjab National Bank share was available at 240 odd bucks before Nirav Modi has done this scam. And after Nirav Modi has done this scam of 12,000 odd crores, today the same share is available for 60 odd rupees. It's not that just because of Nirav Modi default, the share has come down to 1/4 of the value, but it had a big contribution in this downfall of the share. So I hope these 5 points are crystal clear to you guys. Okay, so yes, at current valuation, a lot of banking stocks are looking cheap, and we do have a greed to buy as many as possible, but we have to play it very safe, guys. As I always say, diversification is a key, and that is where my role comes into the picture. For all my clients, I make sure I don't make them over invest in particular scripts. Further, if my clients are listening to this video, you have to be very smart. Not always will I be able to realize that what all stocks you're holding in your portfolio. If I already have made you buy couple of stocks from the banking sector, then you should be proactively telling me that, sir, we are already having X and Y shares of the banking share. Do you still want me to buy this share? And that is when I might probably go for a different sector. I might prefer to pick IT sector or FMCG or pharma sector, but I don't want to put too much money in banking sector just because banking stocks are available at 50, 60, 70% discount. Does not work like that. I have given you 5 reasons why you can't blindly keep buying more and more stake in banking companies. Okay, another very useful tip, guys, which you need to understand is, okay, so you understood one thing, I don't have to buy a lot of banking shares. मतलब मैं ICICI बैंक, HDFC और एक्सिस बैंक तीनों का शेयर्स नहीं खरीदूंगा. वेरी गुड. ओके, पर सर मैं ICICI बैंक का शेयर खरीदूंगा, श्रीराम ट्रांसपोर्ट का शेयर खरीदूंगा और इंडिया बुल हाउसिंग का शेयर खरीदूंगा. नहीं सर, अगर आप ऐसा करते हैं तो यू आर स्टिल मेकिंग द सेम मिस्टेक, बिकॉज व्हेन आई टॉक अबाउट बैंकिंग स्टॉक्स, आई एम रेफरिंग टू बैंकिंग शेयर्स, आई एम टॉकिंग अबाउट NBFCs, and I am also talking about housing finance companies. If I am telling you to avoid banking sector overexposure, I am referring to all these 3 sectors taken together. You having Shriram Transport in your portfolio, or Bajaj Finance, or Bajaj Finserv, or India Bull Housing, or PNB Housing, or HDFC Limited, or HDFC Bank, or Axis Bank, they all fall under the same umbrella, that is the finance companies. So overall exposure in finance companies should still be kept on a lower side. नहीं तो सर आपका डाइवर्सिफिकेशन नहीं होगा. आप इन सब में से एक या दो स्टॉक्स खरीद सकते हैं, पर अगर आप सोच रहे हैं कि अभी सबके सब स्टॉक्स सस्ते हैं तो मैं सब में इन्वेस्ट कर दूं, ऐसा नहीं है. एंड गिवन द सिचुएशन विच वी सी फॉर नेक्स्ट 3 to 6 months, RBI and government is going to be a little more harsh on banking stocks, because they will bring some more stimulus, and most of this stimulus will be directed to the public through banks. Okay, sir, if all this you're saying now, then why did you in first place make us buy the banking shares? That question might be there in your mind, and you might be charging me after this video, which I will not allow you to do. Now listen to me carefully, guys. Banking system is the spine of any economy. Banking system is the spine of any economy. The economy is standing on the banking sector. When we say the economy has gone for a recession, or we say economy has gone for a downfall, the first indicator of that is a couple of banks filing for bankruptcy. Remember one thing, it is very, very difficult to get a banking license in India, but once you get a banking license, RBI through its monetary policies will make sure they won't let any bank fail. The best example in front of you is the Yes Bank. As soon as government realized that Yes Bank is on the verge of failing, they immediately took a charge of it, and they are now going to make sure that in next 2 to 3 years time they will do whatever they need to do to bring its revival. So you need to understand, when you put your money in the banking shares, your money is in safe custody. Don't worry about that. But at the same time, as a smart and active investor, and foreseeing the situation for next 3 to 6 months, we need to understand that we can't increase exposure in banking shares too much just because the shares are available at hefty discounts. Hope guys you like the video. If you want me to make video on other topics, please let me know in the comment section below. Till we meet again, guys, bye bye. God bless all of you. Thank you.